Look, you did it. You actually did it. You saved $100,000. That's not nothing. That is genuinely a big deal. Most Americans don't even have $1,000 in savings. Not a typo, 1,000. So you're sitting here with 100 of those thousands, and you should feel proud. But here's the thing. There is a version of you, a version that's sitting in a chair right now, 3 years from now, who is going to be furious, quietly furious, because they did what everyone told them to do. They were responsible, they were smart, and somehow, they ended up behind. And that right there, that is what we're talking about today. Because the most dangerous place in your financial life is not when you have nothing, it's when you have just enough to make a bad decision and feel good about it. Let me paint you a picture, real quick. Sarah, 29 years old, she spent 6 years being incredibly disciplined. No vacations, no fancy dinners, brown bag lunches every single day. And she finally crosses the finish line, $100,000 in her savings account. She's buzzing. She calls her mom cries. And then someone at work says, "Hey, you should buy a house. Rent is just throwing money away." And her uncle says, "You should dump it all in the S&P, set it and forget it." And her college roommate says, "Real estate is the only real wealth." And a YouTube ad ironically says, "Have you heard about index funds?" And Sarah, smart, disciplined, incredible Sarah, freezes. And in that paralysis, she does the worst thing possible. She puts it all in a high-yield savings account and tells herself she'll figure it out later. 3 years go by, she's earned maybe 4%. Inflation ate 2.5 of that. And you know what? She's actually slightly poorer in real purchasing power than the day she started. Does this sound familiar? Because this is not a rare story. This is the default story. So here's what most people get wrong, and I say this with love, genuinely, because I've watched smart people make these mistakes over and over again. Mistake number 1, they treat $100,000 like it's a destination. They get there and they stop. They exhale. But $100,000 isn't a finish line. It's a launch pad. And if you stop on a launch pad, nothing happens. You just stand there while rockets fly over your head. Mistake number 2. They diversify too fast before they understand anything. Look, I know diversification sounds like wisdom. Your financial advisor loves saying it. But there's a difference between diversification as a strategy and diversification as a fear response. Most people with $100,000 are not diversifying. They're panicking and calling it strategy. Mistake number 3, and this one is going to hurt a little. They try to be too clever. They hear about some friend's cousin who made a killing on crypto in 2021, and suddenly $100,000 feels like a ticket to the life they actually want. So they bet on a long shot, and most of the time, they lose. Nick underlines 3 words on the board: patience, structure, sequence. Patience, structure, sequence. Write those down. Those 3 words are going to do more for your financial future than any hot tip or Reddit thread ever will. Here's a number that should genuinely shake you a little. $100,000 invested in a basic S&P 500 index fund in 2003 would be worth approximately $1.4 million by 2023. 20 years, no stock picking, no crypto, no guru needed. Say that out loud for a second. 2% inflation, you'd have the purchasing power equivalent of about $70,000. You'd have lost $30,000 by playing it safe. Nick draws 2 lines on the whiteboard, one shooting upward, one slowly declining. Label them invested and savings account. That's not hyperbole, that's just math, and the math doesn't care about your feelings or your fear or your uncle's advice. The framework. What you should actually do with $100,000. Let's get specific. Let's get real. Think of it as a pyramid, not because it sounds fancy, because the shape actually matters. The base is the widest. It holds everything else up, and you build from the bottom. The bottom tier, and this is non-negotiable, is your foundation. Before you invest a single dollar aggressively, you make sure 3 things are locked in. 1. You have a fully funded emergency fund, not inside the $100,000, separate. 3 to 6 months of living expenses. If you don't have this, take $15,000 to $20,000 of that 100 and park it in a high-yield savings account right now. Done. Don't argue with me on this one.
2, you have zero high-interest debt. I don't care how exciting the market looks. If you've got credit card debt at 22% interest, that debt is the best guaranteed investment you can make. Pay it off. Every dollar of high-interest debt you carry is a dollar earning negative 22%. Once the foundation is solid, and only then, you move up the pyramid. The middle tier is your core wealth builder. This is where the bulk of your 100,000 lives. We're talking 70 to 80% of what's left after your foundation is funded. And for most people, this means low-cost, diversified index funds, an S&P 500 fund, maybe a total market fund, maybe a small allocation to international, something like Vanguard's VTSAX or Fidelity's FZROX. Boring, proven, powerful. Warren Buffett, in his 2013 letter to Berkshire shareholders, literally advised that 90% of his estate should go into a low-cost S&P 500 index fund. If it's good enough for Buffett's advice, it's good enough for us. The top of the pyramid, the smallest portion, is your growth allocation, 10 to 15% maximum. This is where you can take calculated risks, a sector ETF, individual stocks you've researched deeply, real estate if you have the knowledge and appetite, maybe a small business investment. This is your permission to be a little more aggressive, but it's the top of the pyramid for a reason. If it falls, the foundation and middle hold you up. And here's the metaphor I want you to hold on to. Think of your money like a basketball team. Your emergency fund is the defense. It keeps you from losing. Your index funds are your star players. They show up every single game. And your growth allocation? That's your sixth man. Exciting, sometimes spectacular, but not the one you build the whole team around. The timing trap. Now, there is one more thing I need to talk about because it silently destroys more wealth-building journeys than almost anything else. It's called waiting for the right time. You're going to hear yourself say things like, "The market's too high right now. I'll invest after the election. I just want to wait until things calm down." And it sounds logical. It sounds prudent. It is a trap. Stat: a JP Morgan asset management study found that if you missed just the 10 best trading days in the market over a 20-year period from 2001 to 2021, your annualized return would have been cut nearly in half, from 9.5% to 5.3%. The best days in the market almost always come right after the worst days, and you cannot predict either. So the only winning move, counterintuitively, is to stop trying to time it. Invest consistently, invest automatically, and let time do the heavy lifting.
Dollar cost averaging. Look it up. Practice it. It's not exciting. That's the point. Here's the part nobody talks about, the actual secret. And I know everyone says, here's the secret, and it ends up being nothing, but stay with me. The real power of $100,000 is not the $100,000. It's what that $100,000 does to your psychology. When you have that kind of foundation, you start making decisions from abundance instead of fear. You negotiate your salary differently. You take career risks you wouldn't take when you were living paycheck to paycheck. You say no to bad opportunities because you don't need to say yes. You sleep better, genuinely. There's actually research on this. A study published in the journal Psychological Science found that financial security directly improves cognitive function and decision-making capacity. Scarcity, literal financial stress, actually reduces your IQ-equivalent decision-making ability by about 13 points. That's not a metaphor, that's neuroscience. So, when you invest this $100,000 intelligently, you're not just growing money, you're buying back mental clarity. You're buying the ability to make better decisions in literally every other area of your life. That's the real return on investment, and you cannot put a number on it. All right, you're here. You've got $100,000. Here's exactly what you do this week. Not someday, this week. Step 1. Open a brokerage account if you don't already have one. Fidelity, Vanguard, Schwab, any of the big three. No crypto exchanges, no apps that feel like a casino. A real regulated brokerage. Step 2. Fund your emergency account first. Separate bank account,
High-yield savings, 3 to 6 months of expenses. Do this before anything else. Step 3. If you have any high-interest debt, anything above 8%, pay it off before investing the rest. Guaranteed return beats speculative return every time. Step 4. Set up automatic investments, not a one-time purchase, automatic. Monthly contributions into your index fund of choice. Make it invisible. Make it boring. Watch it grow. Step 5. Leave it alone. Seriously. Don't check it every day. Don't react to headlines. Don't let your brother-in-law talk you into moving it. Leave it alone. Look, you didn't save $100,000 by accident. You did it through discipline, through sacrifice, through choosing differently than most people around you every single day. Don't let the last mile of the race be where you stumble. The people who build real wealth, not lottery winner wealth, but quiet, compounding, generational wealth, they don't do anything extraordinary. They just do the ordinary things extraordinarily consistently. You already proved you can do that. You've got the $100,000 to show for it. Now, let it work for you. Not tomorrow, not when the market calms down, not after you do a little more research. Now. If this helped you, share it with someone who needs to hear it. And if you want the exact portfolio breakdown I personally use, that's in the next video. See you there.